Hello, everybody. Thank you for joining us this afternoon. I hope we are having a great weekend. You can share the video, you can invite somebody, and you can also just comment in the comment section if you have any comment that's relevant to what we're discussing this afternoon. And also, if you have a question, we really appreciate. Thank you again for joining us. Today, we're talking about taking calculated risks in the creation of wealth. Taking calculated risks is crucial in many areas of life and business because it drives growth, innovation, and opportunity while minimizing unnecessary exposure to failure. Businesses, entrepreneurs, and individuals who assess opportunities and take strategic risks are more likely to develop new products, enter new markets, or adopt novel ideas that can provide a competitive edge. In this talk with Themba, we will present some real-life examples of taking calculated risks. Once you master these concepts, you will create wealth in a very leveraged manner. Themba, do you have any news from this past week for our viewers?
Yes, I always have news, Tafadzwa, and I'm so much looking forward to this session on taking calculated risk. Let me just touch on 3 or 4 things. So the first thing is the interest rate cuts that we heard about in this past week. So last week we spoke about the possibility of interest rates being cut in September. It happened in this week. So in America, the Fed actually surprised many investors and many people with a jumbo 50 basis points interest rate cut, bringing down interest rates from a 23-year high in America. I think many people, including economists, had expected a smaller, more conservative 25 basis points cut. And what we saw happening soon after that jumbo 50 basis points interest rate cut was that the stock market responded in America with some of the indices there reaching some of their best levels. So I think that was the most significant thing that happened in this week. Following on the interest rate announcement in America, in South Africa, the Reserve Bank governor also lowered interest rates. So they cut the repo rate, the repurchase rate by 25 basis points. It's now at a level of 8%, which is the first interest rate cut since the pandemic 4.5 years ago. Unlike the cut in America, I think the 25 basis points was more or less what we were expecting here. Before this interest rate announcement in South Africa, I think we had received news the previous day that inflation was within what the Reserve Bank would want to target the inflation. So currently, consumer prices only increased by 4.4%. So let me just say 3 things, Tafadzwa, in response to those interest rate announcements. The first thing that I would want to say is that obviously, from a consumer point of view, it's always a good thing when interest rates are cut. But our advice is that people should continue to reduce their debts. Obviously, these interest rates are coming at a time when households are stressed. So the first thing that we advise people is that continue the acceleration of debt payments, because we don't really know what's on the horizon. The second thing that I would want to say is that let's not get so excited about these interest rate cuts. I'm reading a number of reports which are basically saying that central banks will continue to cut interest rates. And so there is a lot of excitement and buzz in the investment world. I like what the sub-governor, the South African Reserve Bank governor in South Africa said. He essentially, which is what all governors would do, he just highlighted some of the risks that are out there. So he spoke about, the fact that geopolitical risks are heightened. Geopolitical risks essentially, refers to the risk of people going into conflicts or countries fighting, or the risk of especially countries fighting each other. So one of the things that I picked up from his presentation is that geopolitical risks are heightened, and that could generate further interest in further economic shocks. The reality of the economic world that we are living in is that it's a very uncertain economic environment. And therefore, it does not always follow that now that we began the interest rate cutting cycle, it's always going to be like that in the short to medium term. There is always the possibility of further economic shocks, particularly coming from factors such as geopolitical risks, political uncertainty, and the governor highlighted things such as trade restrictions and the rising debt levels. So our advice is that now that interest rates are coming down, you will get savings on your home loan payments, savings on all your debts. If you can afford it, continue paying the same amount that you were paying so that you could accelerate the debt repayments. The third thing that we would advise people to do is to continue invested in the stock markets, because what normally happens is that when interest rates come down, in other words, lower interest rates are very good news for the stock market. So as what happened in this week, if interest rates are coming down, we normally see stock prices, picking up. And they pick up for the simple reason that, the lower borrowing costs free up cash for companies so that they can reinvest in projects or even return some of that cash to shareholders. So that's normally what we see. So we need to obviously continue accelerating our investments. The long and short of what I'm trying to say is that it's definitely good news for interest rates to be coming down. But let's not forget that we live in a very uncertain economic environment, and there are always risks out there. I normally hear people struggling with building emergency reserves in their personal finances. If you've got breathing space, take the opportunity to build those buffers that you need in your finances. Take the opportunity to accelerate debt repayments. So that's our advice. But I also have got bond payments, so I'm really excited when interest rates come down. The second thing, Tafazo, that I would want to touch on in this update is a trend that I have seen with some of the products that are being introduced by banks and by credit providers, especially in South Africa. As we know, Tafazo, and as we've been highlighting, South African consumers are battling with affordability, because of the record, high interest rates that we've experienced over the past, 4 years. And so what we have seen is that a number of credit providers are offering, let's just call them vastly extended loan terms, so that they could make those purchases more reasonable in theory in the eyes of the consumers. So just to give you 3 examples, Tafadzwa, you would know that over the years, we have seen the loan repayment period for vehicle finance being stretched from 5 years to 6 years. So when I started doing loan transactions or signing motor vehicle finance agreements, it was always a standard 5-year agreement. But over the years, we've seen some institutions extending and stretching that to 6 years, which was fine. But now I understand that there is, one or two credit providers, West Bank particularly, who have even stretched that to 96 months. In other words, to 8 years. Imagine paying for a motor vehicles for 8 years. So I'm giving motor vehicle finance as an example. The other example that I would want to give is even personal loans. So I think one bank here, I will not mention the name, has extended loan terms for banks to 84 months. So you're given a personal loan to pay over 84 months. In other words, over something like close to 7 years, just paying a personal loan. And we've seen even the same trend happening with smartphone contracts. As you would know, Tafadzwa, most of these smartphones are becoming very, very expensive. And so what we are seeing more and more is that some of these providers are extending the loan repayment periods from 2 years to 3 years. I think the one that I have seen now, it's a standard 3-year agreement. But in this past year, we have even seen companies extending that loan agreement to 4 years. So especially when we talk about these new devices, the iPhone 16, some providers have even extended loan contracts to 4 years. Now, it's not wise for anybody to be paying a cell phone over a 4-year period. It's not wise for anybody to be paying for a personal loan over 6 or 7 years. We have seen also the same trends when it comes to home loans. Years ago, a home loan in South Africa was a standard 20-year agreement. Now we've seen home loans being extended to 30 years. So here is the thing that we're saying. Be very careful about these extended loan agreements, because it may look like you can afford it at the moment, and therefore you'll enter into that extended loan agreement. But what tends to happen is that over the number of years that you are tied to that agreement, you are essentially being trapped into a debt trap, so to speak. And that's how people get trapped into a debt spiral. So our advice is that just to work with the conservative standard loan agreements that we used to. A motor vehicle finance should be paid over 5 years, because that more or less aligns with the useful life of a motor vehicle. A cell phone should be paid over less than 2 years. And so don't get, trapped by some of these extended loan payments, because that's a recipe for disaster. You will forever be trapped in debt. The third thing that I would want to talk about, Tafadzwa, is a Wall Street Journal survey that I was reading about. So in August, the Wall Street Journal, which is a very authoritative publication in America, especially in the area of finance. They actually ran a survey in August asking people how much they need to be happy. So they really asked people to indicate what their salary was, right? So somebody would say, I earn, for example, $50,000 a year. So then they would ask a second question, how much do you think you need to be earning to be happy, right? So there was a trend that came out of this survey. For instance, somebody would say, I earn 50,000. I believe to be comfortable and to be happy, I need 75,000. You would think that the people who are earning 75,000 would say, I'm really comfortable with 75,000. But what would happen is that those that are earning 75,000 would say, I really need 100,000 to feel comfortable. You would think that those that are earning 100,000 would say, I'm really comfortable. But the trend that came out is that those that are earning 100,000 always would say, I need 150. And even those that were earning 250,000 a year would say, I need 350,000 to be truly happy. So the question is, how much do you need to be earning to be happy? I think what this survey really highlights is how elusive the concept of contentment is really. Um, I think that in our wealth accumulation journey, yes, we are aiming at building wealth, but at some point, regardless of how much you make, you need to reach a certain level of contentment. Otherwise, you would always be chasing targets, and you would think that I need 100,000 more to be happy. And then when you get to 100,000 additional income, you'll actually see that your expenses would have increased, and then you need more. And so it seems that the goalpost in terms of that level that will actually satisfy you will keep on moving. So we advocate for you to pursue this journey of wealth creation with a certain level of contentment. And that level of contentment comes when you've got a balanced financial plan. So what we always advocate is to have a holistic financial plan, which is personalized, which really addresses a number of things, and will build a sense of security, a sense of freedom, and a sense of contentment, which is very important. When I looked at this Wall Street Journal survey, it became clear to me that in this journey of wealth creation, people just chase numbers, and they're chasing numbers, sometimes getting deeper and deeper into debt, but they are not necessarily on this journey with peace of mind, which comes from being content. Now, how do you become content? I think just have a holistic financial plan which addresses all those things that would really give you a sense of a peace of mind, so to speak. So don't just chase numbers. It's not about, if I were to earn a salary of 2 million, I would really be sorted. What you will actually find out is that even if you were magically going to earn 2 million a month, you would not necessarily be content and be happy and having a peace of mind in whatever you do. Just talking about contentment, Tafazo, you know who my favorite investor is and who my role model is? It's a guy called Warren Buffett. I always follow stories about Warren Buffett, and I read his books and even read some of the things that happens in his daily life. And just to mention something which is very, very related to what we were talking about here. So what literally happened is that Warren Buffett's daughter approached him, and she was asking for money to extend her kitchen, to build a kitchen. You would think that Warren Buffett, being a billionaire, would easily write that check and say, "Oh, my daughter, go and extend your kitchen." That's not what happened to Afonso. Warren Buffett refused to give her daughter the loan and actually advised him and to say, "Look, go and get the loan from the bank, because that's what everyone else does when they want to do these kinds of things that you are doing." I think when I read that story, it just taught me quite a number of things in terms of how we should raise our children on on this financial journey. I think we need to introduce a certain realism in terms of how finances should be managed and how they need to balance, just chasing assets, chasing numbers, with actually being content and having a holistic financial plan. In my mind, a holistic financial plan is a financial plan that provides for buffers. When I talk about buffers, I'm talking about emergency funds, insurance, an increasing balance sheet, being able to do charitable activities, and even helping others, because that's very, very important in terms of achieving, contentment. So I thought I should just touch on that, Tafazo, and just talk about this Wall Street Journal survey and what we learned from it. That at the end of the day, people get caught up in a rat race, and they're just chasing numbers and trying to be like the Jones next door. You're not going to build wealth that way. Let's move on, Tafazo, to the next thing.
Thank you very much for that. Two questions just came to my mind when you're talking about contentment. Isn't it the more you have, the more you can also impact? When do you then, like, if you say you need to be content, you can be content at 5 million, but are you not limiting yourself? Because maybe your capacity is to be a billionaire, then you impact more people. Is this contentment on personal level, or what you can do to impact humanity? That's the first question. Then the other one, I've heard in a number of speakers, especially in church setup, and they've said regarding wealth, there are some territories where you cannot enter. There are some levels maybe of wealth where you cannot enter without getting yourself into some covenants. How do you reconcile that with taking risk and also contentment? I hope my question is making sense, because they're saying maybe that's how people end up getting into these Illuminati or whatever groups, because there's a certain level of wealth where you can't enter normally.
I hear you, Tafazu. But when I talk about contentment, there are three things that I'm really talking about. The first thing that I'm really talking about is that at some point, as you accumulate wealth, you need to understand that at one point you can only drive one car at a time. You can only sleep in one bed at a time. You can only, really watch one TV screen at a time. What I see most of the time is people trying to accumulate things and thinking that those things will actually make them happy. And it doesn't necessarily follow. So that's the first point that I'm really talking about then. We need to get to a level where it's not just about chasing money. It's about making an impact within the world that we are living in. Because if you're not content, Tafanzo, you will always think about, I've got 3 cars. I need to have 10 cars, 20 cars. I heard about one entrepreneur who's got 20 cars, and those 20 cars are just parked, and they are for sure. That to me is, those cars do not serve a purpose. Even if you've got a Bentley and you've got those cars in a showroom, what is the point, that you have? Because in our, part of being part of being content simply also means that you've got an understanding that assets must be productively employed. I don't understand somebody who's got 10, luxury cars in a showroom for show off, and those assets are not productive. So that's the first thing that I'm actually trying to say. The second thing that I'm actually trying to say is that, Tafadzo, we are all mortal, and at some point we're all going to die. You're not going to take all those assets to the next world. And that's the real thing that I'm also saying. But there is also a third thing that I'm saying about being content. What I'm basically saying is that if I look at people that really make money, they are not trapped in this mirage of it's all about income, right? At the end of the day, even if you earning 2 million, right, but you're not concerned about asset acquisition, all you will have is, more earnings, but very little in asset acquisition. So I will not go into all issues that you have spoken about, Tafadzo. Maybe that's for another day. But those are the things that I'm really talking about. Um, um, Pursue the journey of wealth creation with a certain level of contentment. That's my advice. It's not a concept that is easy to explain, but I think you will make much more progress that way. Even if we were to give you salary increments, but if you're not content and you are increasing your expenses, it's not going to help you. Hopefully that makes sense, Stefan.
Thank you. Today our book of the week is a book titled You Are What You Risk, The New Art and Science of Navigating an Uncertain World by Michelle Walker. What is this book all about, Themba? And maybe as you address the book, Angelita is asking, can you apply the same principles of calculated risk to a business, in brackets, SME?
Oh, very good. That's a very good question. Tafadzo, last week we started talking about asymmetrical risk. We now talking about calculated risk. Let everyone who is following us just understand that today's discussion is an extension of last week's discussion. And when we were introducing the discussion last week, I did point out that although asymmetrical risk is a financial concept, it can be applied in all areas of life. The same applies to what we're talking about when we talk about calculated risk. It's not only a concept that you apply with bigger business, you apply it with small to medium enterprises, and you also apply it even in your own personal life. All right. So at the end of the day, all I'm trying to say is take calculated risks when it comes to entrepreneurship. Take calculated risk when it comes to your career. Take calculated risks when it comes to even religious beliefs. So this is something that is applicable in every aspect of our life. The author that we're looking at today is a lady called Michelle Walker. Now, Michelle, and this is the other thing that I like about Michelle, she blends psychology, economics, and leadership principles to really come up with this concept of risk taking. So she actually explores the concept of risk taking into the psychological, cultural, and social factors that influence how individuals and organizations perceive and manage risks. I found this book to be very interesting, but I wish I had all the time to tell you what I got from this book, but probably I can focus on five, key takeaways. But before I mention those five key takeaways, um, there is an observation that Michelle makes. This is a book that was written in 2021. It's a very recent book. And the one observation that she makes is that we are living in an uncertain world. Let everyone who is following this discussion understand this. We are living in an uncertain world. The uncertain world that we are living in presents, a number of risks. And so, this book is about how do you navigate, what is the art, what is the science of navigating in this uncertain world. Once you understand the uncertainty in the world, you will also begin to know that only taking calculated risks will help you to navigate and to seize opportunities in this uncertain world. For example, Tafadzo, many people are even thinking about now that interest rates are coming down, they will continue coming down. I just want to warn people out there. This world is so uncertain that even next month we could be talking about rates going up. And therefore, as you navigate your way in this uncertain world, it does not mean that you need to be risk averse, because only the people that take calculated risks are going to innovate, are going to grow, and are going to seize the opportunities and to anticipate challenges in this uncertain world. But here are the five takeaways. If I were just to be, quick about what I learned from this book. Number one, she introduces the concept of a risk fingerprint. As you know, Tafadzwa, each one of us, every individual has got a unique fingerprint which identifies, them. So Michelle introduces this idea of a risk fingerprint. Um, and this risk fingerprint basically is a result of your background, of your culture, your experience in life, and it shapes, how you actually, take risk in life. For example, when it comes to personal experiences, she mentions the fact that, life events, your upbringing, the past outcomes of your risk taking, will influence your future decisions. For example, somebody who has experienced financial hardship in life may be more risk averse than somebody who hasn't, experienced, financial hardship. She talks about cultural background. So there are certain cultural norms and social expectations that can impact how people, view risks. She talks about personality traits that also influence your risk fingerprints. So she's basically highlighting the fact that people don't just take risk in a vacuum. Their risk taking is influenced by a complex mix of internal and external factors. So I just found that concept of a risk fingerprint very important. Once I understood that concept of a risk fingerprint, as a parent, I think I resolved to, create situations of learning for my children so that they are not limited in taking risks, but that they can take, calculated risk in their lives. Secondly, she talks about, learning from failures. So she makes the point that failure and risk are intertwined. So we need, to learn from our failures. Even after we've taken calculated risk, we need to learn and adapt to new conditions. And that's vital for, personal and professional growth. So let me put it in a framework for you, Tafadzo, so that you understand. Number one, the world is very uncertain. Take calculated risk. Don't be reckless. Don't suffer from inaction, because that could, happen to us. Take calculated risk. When you take calculated risk, there is no guarantee that you will succeed, but learn from it. That's the second thing. Continually learn from it. So you must incorporate learning in whatever you do. And as you learn from it, adapt. That's very important. That's the art and the science of navigating in an uncertain world. In an uncertain world, don't do reckless risk taking. Don't suffer from a risk averse attitude where you will say, because the world is uncertain, I will just fold my hands and not do anything. You have to take calculated risk for you to create wealth in an uncertain world. But because you have taken calculated risk, it doesn't guarantee you success. But after you've failed, learn from it and then adapt and continually move from it. She talks about risk ecosystems. So she emphasizes the point that risk is not taken in isolation. So we are operating in a complex environment, and in that complex environment, our risk taking is influenced by our family, our work, our society, and broader economic conditions. So these ecosystems play a major role in shaping how we take and how we manage risk. So that's the book. I think let me stop there. I would have wanted to share some of the things that I learned from this book, but there are 3 points that I'm highlighting here. Number one, it's a very uncertain environment that we are living in. Number two, only the people that take risks are going to prosper. But in taking risks, you need to understand your risk fingerprint. I think it's something that can be improved in terms of your risk-taking abilities. But at the end of the day, you are what you risk. At the end of the day, you are definitely what you risk. Let me move on to my thought for the day. My thought for the day does not come from the book itself. It comes from a quote by Benjamin Graham. Tefadzon, do you still remember who Benjamin Graham is? I just want to test whether you following. I've spoken about this man before. He's one of my favorite characters. Do you still remember who he is?
Is he the mentor of Warren Buffett?
Spot on. So you don't have to finish. Benjamin Graham is the person who mentored Warren Buffett. So Warren Buffett is my favorite character. He met Benjamin Graham in school. So most of the investment philosophies that Warren Buffett, has, came from Benjamin Graham. When I introduced this Benjamin Graham, it was in the context of mentorship. So you need a mentor. Even Warren Buffett had a mentor. So the quote from Benjamin Graham goes something like this: the essence of investment management is talking about managing investments. You're managing investments. The same thing that Warren Buffett does is the management of risks, not the management of returns. So let's just break down, that quote. As an entrepreneur, don't just chase return and try to maximize your profits. As an investor, whether you're investing in a project, you're investing on the stock market, don't just chase returns. The essence of managing investments is the management of risk. So at the end of the day, if you want to profit in this uncertain world, one of the greatest skills that you need to develop is the management of risks. If you cannot manage risks, if you cannot take calculated risks, you will never be able to manage returns. So it's not about just profiting in this world. You profit from the calculated risks that you have taken. But the essence of investment management, even when you are building a portfolio, it's not just about choosing the stocks that will do well. It's also about managing the risks. And we'll try to elaborate on that concept as we go on. But let's just move on, Tafadzo. I thought it's an interesting quote and it's well aligned with what we're talking about today.
Thank you for that. You are what you risk. Can you explain the concepts, taking calculated risk without jargon? Yeah,
we always want to simplify things, Tafadzo. So I like it when you say, explain taking calculated risk. Before I explain this concept of taking calculated risk, let's just be clear. This concept applies in every situation in our lives. It applies in entrepreneurship. It applies in making investments. It applies in making career decisions. It's an uncertain world. But because it's an uncertain world, we have to take calculated risk. So taking calculated risk, simply involves carefully thinking about the chances of success and failure before making a move. If there is an expression that I hate, Tafadzo, it's when people say to me, I have taken the plunge. In other words, I have just plunged. I've taken the plunge into marriage. I've just gone into marriage. Don't go into a marriage with your eyes closed. I don't like that. I don't like people who just dive with their eyes closed. I think before you make a decision in business, professionally, spiritually, just carefully think about the chances of success and the chances of failure before making that move. And that's what we're talking about there. And as you're thinking about the chances of success and failure, I would want you to weigh the potential risks against the potential rewards, so that you avoid reckless decision making. And that process of taking calculated risk has got 3 steps to it. 3 steps to it. Even when you are a small to medium business person, which is the question that came our way today, Tafadzo. Step number 1, gather the information that you need, right? So information gathering is very, very important. That's step number 1 of taking calculated risk. Gather as much information as you can. Obviously, like we said last week, Tafadzo, in your gathering of information, you will never have perfect information. Remember the story that I told last week about this merchant who didn't know whether there were 200 sheep or 100. You will never have perfect information, but you need to gather, information. If you are a small to medium business person, don't just launch a product. Do market research, conduct market research. If you are investing on the stock market, don't just buy a share. If there is people that I think need to be taught, these are people who say statements like, investing on the stock market is like gambling. I don't know if you have ever heard that statement, Tafanzo. Investing on the stock market is not like gambling. You do, obviously, to some, it can be like gambling, right? So that's what we're trying to prevent. The opposite of taking calculated risks is gambling. People who are gamblers tend to lose a lot of money and they die poor. All right. So that would be the opposite of taking, calculated risks. In fact, in our presentation, there are two opposites of taking calculated risks. Number one is the people that gamble. Number two is the people that do nothing. Right. So taking calculated risk is, step number one, gather as much information as you can. But don't wait until you've got perfect information. Right. You just need some information on which you're going to base your decision. Number two, mitigate your risks. Right. Take steps to mitigate the downside risks. Right. For example, if you are launching a business, and you've got 1,000 rands that you have kept as capital to launch that business. Don't invest all your 1,000 into this project that you're about to launch. Just be measured about it. There is a concept called lean startups. In fact, that's one of my favorite books that I have read in recent months. It's talking about, it's a concept that comes from somebody who has launched tech companies, because some of these tech companies fail. And he said, look, when you are starting a business, apply this concept of lean startups. In other words, you would want to start small, test the waters, diversify your investments. You don't just use the 1,000, all the money that you have, and you invest it into one project and hope that that product will work. No, that's not how successful business do it. They test the water. They can do a pilot product. They pilot the market. They test the waters. They see whether consumers will welcome the product or not. And then once there is a response from the consumers that encourages them, then they continue to invest further. I don't want to go into jargon and into detail, but it's the step of mitigating your risks, right? So you do informed decision making. And then number three, calculate the expected benefits. So look at the potential reward. If the potential reward outweighs the downside that you have mitigated, that's an asymmetrical risk opportunity. Go for it. So those are the three steps of taking calculated risks. Gather information, mitigate your downside, and look at the expected benefits. For those that are doubting whether such a concept would apply outside of the world of entrepreneurship and outside of the world of finance, let me give you a practical example. Say, for example, you're going into marriage. Step number one is basically go on as many dates with this person as possible. Research about this person, Google them. That's informed decision making. Informed decision making is just gathering information about this person. By the way, Tafadzo, I was reading a report today about divorce rates in China. Divorce rates in China are going up. For some reason, I don't know. We know the Chinese market is, it's growing. But there was just a report, I like reading reports, and it was just talking about how divorce rates are going up. You don't want to be one of those statistics, because wherever I look, whether it's in Africa, it's in China, the reality is that divorce rates are going up. So even when you're entering into marriage, take a calculated risk, because you don't want to be part of these divorce, statistics. So step number one would be informed decision making. Information is about this person as possible. Followers, obtain their credit reports, so that you know how they manage their finance, because you would want to know. Ask them questions such as, what is your view about polygamy, right? Because you don't want to marry a person who has got strange views about polygamy, because it may happen that years down the line they might want to take a second person, or to bring in a third person in the marriage? So ask those questions. That's part of informed decision making. And then
Hello, I think we have network issues there. Themba, can you hear me? It's trying to connect.
hi, Tafadzwa, can you hear me?
Yes, I can hear you now.
I hope. What happened when I was out? You know what happened here is that we had an interruption in the electricity supply where I'm presenting from. What is the last thing that you heard from me?
You were talking about polygamy, so I thought you were interrupted by network. I hope it was not something that you were also planning to do.
Oh, okay. I remember where I was, Stefan. I was talking about how applicable some of these steps could be even in a marriage setup, isn't it? Right.
Yeah.
So step number 2 was mitigating your downside risk. So you could go for an HIV test, for example, as part of mitigating the risk, right? And then the expected benefits, right? So there are so many benefits that come from marriage, and some benefits will flow down the line. So these concepts are applicable even outside of the world of finance. But let's move on, Tafazo. There was an interruption, but let's move on. Yeah.
What would be the opposite of taking risks that are not calculated?
I've already spoken about those opposites, Tafadzwa. There are two opposites of taking of not taking calculated risk. Number one, reckless risk taking. I don't like people, entrepreneurs that are reckless in their risk taking, investors that are reckless. I've even seen, I'm not going to, you don't like me to give some of the examples that happen in churches, Tafadzwa, so I will not give you but all I'm just trying to say that people who take reckless risks act impulsively without often understanding or considering the potential downside or consequences. So just to give you examples of reckless risk-taking, gambling, right? I don't like people that gamble. I don't like people that go and buy a lotto ticket because you don't know the odds. You don't have a strategy. So if you are one of those people that hope one day to get rich because you have bought a lottery ticket, that's a reckless risk taking. Even if the cost of a lottery ticket is very, very small, you are actually better off by investing that small amount. It does not mean that gamblers do not make money. The gamblers that make money, even when it comes to all these gambling games, are people that know the odds of losing. They have calculated the odds by experience. They know the odds, and they have a strategy. So don't go and buy a lotto ticket if you don't know the odds of winning. The odds of winning are very low. You've got a higher risk of being hit by a lightning than winning lotto, right? Another example would be investing in a volatile stock, right? So some people would hear that money is being made in cryptocurrencies. Then you just go and invest in cryptocurrencies without doing your research. We do not invest in financial products, invest in projects without doing research. It's reckless risk taking. Starting a business in a highly competitive market without a business plan or market analysis, right? I see people doing this quite a lot. You've got money, you know that people make money in business, and then you just go and start a business in a highly competitive market. Tafazo, just to give you an example, I know of somebody who got a pension payout and they said, let me buy a minibus and launch it as a taxi on this route. They lost a lot of money. It's a highly competitive market. If you want to go there, do your research, have a plan, right? So that's reckless risk taking. So those reckless risk takers often overlook important information and they fail to manage risks, and therefore they accelerate their chances of failure. The second example of not taking calculated risk is avoiding risks entirely. Right. So risk avoidance, this is when an individual or an organization does not take risk. It results in stagnation. It results in missed opportunities. So let me give you an example. Somebody who says, the stock market is like gambling, therefore I will not invest on the stock market. Right. They are trying to avoid risks. Or somebody who says, I will not invest in a new opportunity because I may lose money. Right? Or somebody who sticks with outdated technology or an outdated business model so as to avoid potential failure or disruption. Or somebody who avoids personal growth by refusing challenges. They want to live in their own world and they don't want to be upset in that world. They are very comfortable in their comfort zone. So all I'm just trying to say is that there are two opposites of not taking calculated risk. I hope that is clear, Tafazo.
I think that's very clear. My next question was for you to share practical examples of calculated risk. I'm not sure whether you've not already touched on that. If you've already touched on that, maybe you can give us concluding comments and where people can find.
Yeah, where people can look. I've got so many examples that I can give of, but let me give you corporate examples, Tafazo. Because sometimes we hear success stories even about Apple, and we think that Steve Jobs just came up with an Apple, with an iPhone and just profited, on it. When Apple launched the iPhone in 2007, it was a typical example of taking a calculated risk. It was a bold move, but it was not, a case of Steve Jobs just plunging into the dark with his eyes closed. Obviously, Apple at that time was known for its computers. It was known for the iPod, but entering the smartphone market was a significant, calculated risk. What Apple did is that they carefully analyzed the market trends, the consumer needs, and the emerging potential of, the mobile internet before releasing the iPhone. So there was some skepticism within Apple itself as a as a company, but the analysis that Steve Jobs did gave him confidence to go into this decision, which has really revolutionized the mobile phone industry. It has transformed Apple into a global tech giant, and it has set new standards for mobile technology. So how did Apple take this calculated risk? They invested heavily in research and development. They had a solid understanding of the user experience through the iPod, which gave them confidence in the iPhone's potential, while minimizing the risks involved. So I can talk about Elon Musk, betting on Tesla and SpaceX. I can talk about Netflix. I can talk about Amazon expanding into cloud computing. I can talk about Richard Branson, launching Virgin Active. Those were bold moves. Innovation is not about plunging into the dark. Innovation and even growth in our own personal areas is an example of taking, calculated, risks, and that's what we're talking about. Tafadzwa, I know that we've got limited time, but I always want to simplify things. I always want to give people a framework of what we're talking about. We always want to equip people with practical tools. So say, for example, you have heard about an opportunity, right, that you would want to go into. Don't go into that opportunity just because everyone is talking about it. Don't go into that opportunity just because you hear that somebody has profited out of it. Apply the steps that we've spoken about. I spoke about the 3 steps, but I would want to just a little bit, Tafazo, give me 2 minutes to elaborate on those steps into further bullet points so that people are able to identify these asymmetrical risk opportunity and really profit on them. So first bullet point, when you come across any opportunity, somebody is saying this is where you will make a lot of money. Just be very clear. What are the expected benefits? What are the downsides? How do I minimize the downside? What do I stand to gain? What do I stand to lose? This also applies when it comes to purchasing of shares. That's the first bullet point. The second bullet point is analyze your probabilities. It's a very uncertain environment, Tafadzo. My second favorite person, Tafadzo, apart from Warren Buffett, is a guy called Themba Mazibuko. I like Strive. I followed his way of investing, his entrepreneurial journey. But when you analyze these people, you will also see that they have made investments that where they have lost money. For example, in his entrepreneurial journey, Strive lost money before he profited on Econet. Econet was an asymmetrical risk opportunity for him. Then he made an investment in a media company. I think it was called Quesa Media. He also lost a lot of money. He lost billions. So let's just understand here that in your entrepreneurial journey, even when you take calculated risks, you are going to have winners and losers. But as long as your winners outweigh your losers, then you are fine. Learn from it. Continue working on it. The fact that you have understood the methodology does not mean that you are not going to lose money. Most of the billionaires that I can give you as an example, at one point or another, made very terrible decision. But take the calculated risk, learn from it, and then adapt. But in taking calculated risk, also calculate probabilities. What are the probabilities of me losing money, of me gaining money? Just having a sense of those probabilities is part of taking calculated risk. Please, please cap your downside. If you are doing trading, apply the stop loss. It's very important to cap your downside. That's how we do it. Even when you decide to borrow money, because as part of our entrepreneurial journey, we will have to borrow money. When you take those calculated risks, use leverage wisely. Use borrowings wisely. Know when to borrow and not, and when not to borrow, because leverage introduces asymmetry in your finances. That's one way in which we can amplify our returns. But you need to use leverage wisely, because that's very, very important. And then diversify and continue evaluating market conditions, because this is a very, very uncertain environment that we are operating in. I hope I have given you sort of a framework within which to operate. whether you are an entrepreneur doing business, you are just, aiming to make decisions, the world is very uncertain. But at the end of the day, you are what you risk. That's what Michelle has actually told us in her book. Let me stop there, Tafadzo, unless there are questions.
I was going to ask, from what you're saying about taking calculated risk and those who have taken risks, like some businessmen who have lost, is there someone who can really be said they are risk takers? Or if you are risk averse, can you learn to be a risk taker by taking calculated risks?
Yes. That's a very good question, which Michelle tries to answer through the whole concept of a risk fingerprint. So by nature, Tafadzo, some people are daredevils. You know, a daredevil. A daredevil is somebody who takes these risks and they are not afraid of taking risks. And then some people are not daredevils, right? So people are wired differently. Some people by nature are daredevils, others are not daredevils. But it doesn't matter whether you are a daredevil or you are not a daredevil. One day, Tafadzo, I was arguing with my son. He asked me a question: are leaders born, or can leadership skills be taught? At the end of the day, I said to him, look, you are born with a certain amount of talent, but leadership can actually be taught for you to be a better leader. The same applies with risk-taking, Tafadzo. You are born with certain traits that enable you to take risks, but through teaching, you can be taught to take better risks. And through learning, I do not know of anybody who was born a daredevil and they made lots of money from being a daredevil. At the end of the day, there is a framework that you can be taught where you can take calculated risks, but there is also learning that you would need to do yourself. You need to learn from it. And then when you learn, you adapt. That's exactly what we're talking about here. I hope I have answered your question, Tafadzo. Some people are born risk takers, but it doesn't necessarily mean if you're born a risk taker, you will die, fabulously well. It doesn't follow. There are things that you would need to be taught. There are frameworks that you would need to be given for you to be better at what you do.
Thank you very much. Angelita says, thank you for mentioning the certainty of failure, and that is a part of the journey. Appreciate this. Thank you very much, Themba. Would you want to share?
Tafadzo, Angelique is saying a very important point. Think of Richard Branson. He has failed so many times. Think of Strive Masiwa, he has failed. But the important thing is to learn from failure and not to raise your hands and say, because I have failed, I'll never attempt again. If you are like that, then you will die poor.
Thank you very much. Would you want to share where people can find you or any conclusion?
The easiest way to find me is on LinkedIn, Tafadzo. So just Google Themba Duplex Mazibuko, connect with me via LinkedIn. That's the easiest way to find me.
Thank you very much for the contribution. We have learned that you can only have one house, one car. You can only wear certain clothes at a certain time. So we need to apply to be content at some stage, and you are what you risk. And yes, I think those are a few takeaways for me. And thank you everyone for joining us. The people who tuned in from Zimbabwe, some from Botswana, some from South Africa, and I'm just mentioning those who commented, but yeah, we appreciate you joining us this afternoon. We hope we'll go out there and take calculated risks. There's no limit for anyone to accumulate wealth as long as I think the motive is right and you know where to end. But let's go out there and do our best. Our dreams are worth fighting for, and let's grow together. If you want to get hold of us, you can write us an email, tafazwa@tafazwamazibukospeaks.co.za. If you are on YouTube, you can also subscribe to our YouTube channel, The Dream That is Worth Fighting For. We don't take your support for granted. Have a great weekend ahead. Let's go out there and achieve our dreams. Cheers.